If I look at the one indicator, China PMI data, it's a single best indicator for the economic momentum in China. Okay. It's firmly above 50. You look at the retail sales data, tourism data, everything has been recovering. And now authorities are hell-bent on reviving the economy and stabilizing the property market. Right. So the change on the property side, I think, is a very good indicator that economy is going to recover, and that's positive for the equity market.
So, I mean, up until this data that you're talking about, folks have been saying that either A, China is uninvestable, or at best a trade but not an investment, or in more diplomatic language known in the community, it's more sort of a tactical market than a strategic market. That story's changed?
I would, to some extent, agree with that. From a long-term perspective, China equity market hasn't really delivered that kind of return compared to the US equity market. But from a cyclical point of view, for the next 6 to 12 months, we do see substantial return potential. With the basement of the economy, earnings are going to recover. The regulatory overhang on the internet stocks are over. Companies are buying back their stocks, and investors are positioned at a very low level. So you are going to see good returns in the China equity market compared to the other markets.
Got to ask you, though, what happens come November? Let's say it's Trump 2.0. Let's say he actually delivers on his promises or threats of raising tariffs on China by up to 60%. What happens then?
Yeah, that's a big risk, tail risk for the China equity market. If the taxes or import taxes are more moderate level, then I don't think it's going to have much impact on China, because China has been diversifying their exports. Now it exports more to Africa, more to ASEAN countries compared to the US market. Yeah. So to some extent, the impact will be moderated. But if there is 60% tariff, then there is a tail risk for the equity market.
Can't escape.